Joining us today, JPM Asset Management's Phil Camporeale. It's good to have you back, Phil. Is it just me, or are you getting a little more constructive here?
Well, here's what we're saying. It all starts with our friends down I-95 at the Federal Reserve. This is the first time, Carl, that I can come on your set in over a year and say we don't expect the Fed to hike rates at the next meeting. That's a statement. So it starts there, because I think the two roads that can take you to a hard landing. The first road was what we were worried about 6 months ago, when we were worried about the Fed needing to break the back of the economy in order to get any disinflation to occur. After 10 rate hikes and 10 consecutive falls in CPI, I think there's significant evidence of disinflation. And then the other road is around the regional bank story. And it's not just credit lending tightening. I think that's kind of a slower burn story over the next couple of quarters. It would be more the fact of, is there a chaotic deposit outflows from regional banks that are scaring the consumer and forcing the savings rate higher that would then lead to a hard landing scenario? If you look at First Citizens' kind of deposit estimates this morning, about 140 billion, expectations for 120. That's a really good sign, Carl. So both of those roads, either a policy error to the upside from the Fed or a deposit outflow story, doesn't really look like they're working out. And then at the end of the day, which we really love as multi-asset investors, if stocks and bonds are behaving, in other words, if you're getting the benefit of diversification from bonds, we can sit right now in a well-diversified portfolio, and if the hard landing scenario starts to pull through, we know that we're going to benefit from bonds. And that's a total departure from where we were last year when bonds were the problem.
You sure that the Fed's done raising rates?
Sarah,
Are you sure that the Fed's done raising rates?
So never assign a zero probability in any event.
Did you hear you heard
yes.
John Williams yesterday?
Yes. So here's the way I would describe the Fed. We are not subscribing, very clearly, we're not subscribing to easing that is priced into the federal funds futures market in the back half of this year. And that's starting in late summer, early fall. We're not at that point, because I think for that to happen,
but if you're
Sarah,
not at that point, then
landing.
how are you bullish? Because that is going to be in a tightening when that gets priced out of the market if it doesn't happen.
Because the easing, we think, could only happen in a hard landing scenario where we think equities could be down 10 to 15% in that scenario. So we're not hoping for an easing over the summer. If that's happening, something is broken. So I think the earliest we can get to that easing is December of this year, early next year, not based on the hard landing scenario, but on the fact that inflation probably at that point could be between 3 and 3.5%, and you do not need a 5.25% federal funds rate at that level. So then that's where the soft landing scenario comes in. They're easing because inflation is falling, not because of a hard landing.
What about, and Kalanovic and you guys over there have made the point that there is asymmetry.
Yeah.
It's the thin path to a soft landing, and many things can break.
Yes.
Right? So what do we make of that?
There's certainly asymmetry on the stock side. So to be overweight stocks here, Carl, you need the immaculate disinflation story, the no landing story, where growth stays very robust and you get inflation to fall. That is not what we're saying, importantly. Okay? But where we do believe there's a lot of good risk-reward opportunities is in the corporate bond market, and that's what is keeping us invested, right? So you have additional yield that you're getting from the corporate bond market. You keep your equities at around a neutral allocation. You out-yield your index, and you create alpha that way. Not the most glamorous trade in the world, Carl,
right.
Sorry, but it's an important trade.
Do you want to stay investment grade, or can you go
investment grade? So if we're solving for income, sure, go into lower quality, but we are really preferring liquidity and quality right now in both the stock selection and the bond selection.